So hello everyone. My name is Kristina Kuprina, and I am the CEO, founder, and also lead portfolio manager and economist at Sequoia Wealth Advisors. For those of you who are new to our webinars, this may be the first time you're hearing it, or someone's sharing this with you, or seeing this on social. We have been doing these webinars approximately once a month for the last 4 or 5 years or so. And the intention of doing it is to not only give updates on the economy and how things are going on the economy, however, it's also for an opportunity for you to ask questions, to be able to learn. Maybe there's things you've heard in the news or something's shared with you and you're like, wow, I'd love to get another economist opinion on it. The highest intention is that this hour of time that you're either watching live or for most of you watching later, because our registration list is always far greater than people are able to do it live in the post-pandemic world. However, we got a lot of questions set in advance, so we'll be good either way. So again, the highest intention is that the time that you spend watching this, you get some valuable information that helps you not only have a better sense of the economy and what's happening around you, but also you have your individual questions answered. That being said, just a couple of notes here. Today, we're going to do two of us on the webinar. So we're going to have not only myself, Kristina Kuprina, who many of you are familiar with, but also Katie Lindfelt, our certified financial planner. Katie Lindfelt has been with us since the beginning of Sequoia's time, and she has a very strong expertise and background in financial planning, tax planning, and a lot of specifics, especially areas like Medicare, health insurance, and how all of these things balance out in your financial plan. And Katie and I have been doing financial planning for our clients for years. And something we've noticed that many people don't often know is all of the parts of your financial life are kind of interconnected and intertwined. A decision you make here can also have impacts on other areas of your life. And organizing and optimizing all of these things is what brings you to a successful outcome. To understand that if we do this over here, how does that impact this decision over here? And everything is so intertwined. In addition, the laws are constantly changing. Tax laws, legislation, the markets and economy are constantly changing. And so is your life personally constantly changing. So the first part of today's webinar is Katie's going to bring up some ideas, some tricks and tips and considerations for year-end planning. The caveat to that is all of these ideas are ideas for conversation to have with your financial planner, or you can have it with us. If you're hearing this, you're like, oh, I'd love to get some more information. Katie and I will be happy to do a consultation with you and answer your questions. And the reason for this is everybody's situation is different. What works so well for one person could be devastating to another person's financial plan. There's so much more, as I mentioned earlier, that goes into this than one simple decision point. However, by giving you these ideas and thoughts, it can trigger the idea of, oh, let me take a look at my plan, make sure everything's up to date. Or there's something else, I didn't even think about this. Maybe I want to explore this idea. For all of you who are clients of Katie's and mine, we're already doing this for you. However, remember the three things I talked about. We don't always know what's most current in your life. So please, anytime you've had a life event, or you're just considering a life change or a life event, please reach out to us so we can start to navigate that space with you as well. After Katie's done and those questions are answered, then I'm going to transition over again to, as I promised, a little bit of post-election economic update and answer the immense number of questions that we've been getting over this last couple of months, tied a little bit more around the economics and the election and the candidates and whatnot. So that being said, any questions you have, please send them in if you have not done so already. The earlier we get them, the more likely we'll be able to get to them during our presentation today. So with that being said, I'm going to take myself off camera for a few moments, and Katie's going to begin with giving you some year-end planning tips, tricks, and ideas.
Kristina. So hi, yes, I'm Katie Lindfelt. We haven't met before. I'm a certified financial planner, and that's really how I come at everything we're doing at Sequoia, everything I do. I start from a planning focus, looking at, where are people in their life trajectory? What do you want to accomplish? What are your goals, your risks, and the other people and entities in your life that matter. From there, we can get to, decisions on what's best for you. And that's really how we look to customize things. So Kristina and I talked about a few things to look at here as we head to year end. Things to consider, double check on for your own personal situation that need to be handled by the end of the year. So I'm going to cover a few of them. Some of them are ideas and things to consider, and others are, some of the checklist homework pieces. So the first one to double check is if you have a 401k or other retirement plan at work. Now is a good time to look at either your plan summary, look at your statement, or look at your pay stub, and the column there that says personal contributions or employee contributions or deferrals. Make sure that amount is the amount you want to be deferring. You have till the end of the year to put money into the 401ks, simples, and 403bs and such. So if you want a particular number to hit there, you have to make that happen by the end of the year. And for those plans, it's a calendar year contribution, and it has to come from your paycheck. So you can't write a check to get it in there. And so, we've got a few months here. If you have not been deferring quite as much as you wanted to, you potentially have some time to catch up there. The maximum deferrals in 401ks for 2024 are 23,000 with an additional 7,500 if you're 50 or over. And so those are some numbers to double check. 401ks and 403bs are the same deferral limits. So the next one would be IRA and Roth contributions. You actually have till April till you file your taxes to do those. But if that's a large lump sum, it's often great to get going ahead of time to make those IRA or Roth contributions. So look to see what you've done. If you're with us, reach out. We can tell you what your contribution amounts have been so far this year, just so you can be planning ahead. Because if you have a bunch due in taxes at tax time, having to also write a $7,000 Roth check or IRA check is not so much fun. So for IRAs and Roths, it's 7,000 for 2024 with an additional 1,000 if you're 50 or over. And that gets me to two of my favorite subjects with IRAs and Roths. The first being Roth conversions. A number of years ago, the income limit on Roth conversions were taken away. What this means is that anybody who wants to can take from pre-tax and move to Roth or post-tax money that's in an IRA. This counts as taxable income in the year in which you do this. And so that's why the last quarter of the year is a really good time to look at that. You have a much better idea of what your taxable income is going to be for the year. And so you can look to decide, do I want to do some Roth conversions? In planning, this is something I look at with every single client. Does this make sense for them? And particularly in the interim years between retirement and required minimum distributions, you can have a couple of years there where you have lower taxable income. And what matters most is not if you put the money in an IRA or Roth, it's that you pay the taxes in the lowest brackets possible for you. So now's a great time to look at that, see if it makes sense to do some level of Roth conversion. And I say level, you don't have to convert an entire IRA. A lot of times we don't. That often doesn't make tax sense. We do it strategically in chunks over a few years. And Roth conversions are great. IRAs, you have to take money out starting at about age 72. You have to start paying taxes on it. Once you put money into a Roth, it can grow and there's never taxes on it again. It's a really spectacular bucket of money to have when we look at where you're taking income. In retirement, we can grab from a variety of sources. So my other one to look at here is going to be charitable distributions from those IRAs. This is allowable after 70 and a half, and If you're in that age bracket and looking at when you have to take required minimum distributions, you may know that for many people, you don't have to start taking those until 73. Charitable distributions from IRAs are still allowable starting at 70 and a half, even though you don't actually have to take distributions. What is this? This means that you can have money sent directly from an IRA to a charity. It has to be a legally filed 501c3 charity, and it is a non-taxable event. So it goes from your account with the check issued out directly to the charity. It can't go to you first and then you write the check. And so it comes from the account, but it's non-taxable. Why would you want to do this? Well, currently, under our current tax law, a majority of people are claiming the standard deduction because it is so high. And so those charitable gifts, you may not be getting any tax benefit for it. So it may make more sense for your situation to take it from your IRA. It's a really neat way to play it, to do this. And you can actually send a sizable amount of money. You can do up to $100,000 as a charitable distribution. One big caveat to this rule that is quite messy is that if it is coming out of your IRA, it needs to be the first money that comes out. I know it's October. If you're taking money from an IRA, you've probably already done it. So in that case, this is a planning strategy for next year. You could set your distributions maybe to start, the 15th, but have a charitable distribution go out on the 1st of January, those sorts of things. I don't know why the rule's that way. Seems very awkward and a bit of a mess to deal with, but you do need the money to come out first to the charity, and then the remaining of the money for any distributions you want to take or have to take come out afterwards. This is a really neat option for people right now, and happy to discuss with anyone how it might fit in their particular situation, and privately look at, does it make sense to pull from here versus, if you're writing a check and it's coming from your checking account. The other big piece that we really skipping ahead of myself. The last one that is really very end of the year and accounts related, we're going to look at if you're working and you have a flexible spending account. This is a medical account. Money comes out from your paycheck, right? And it goes in, you can pull it out for medical expenses. These are really great. You get a federal tax deduction. You don't get a California tax deduction for putting it in there, but it can stretch your dollars a little farther for medical spending. These have to be emptied by the end of the year. So now's a really good time to log in, see how much money you have in there. Are there any, eligible items that you tend to purchase that you could stock up on? Do you need to make it? It is the more flexible of types of appointments tend to get real busy. The eye doctors, real busy in December because so many people have money still sitting in those accounts. So now's a good time here in October to take a look, see if you have some unspent funds, and utilize those, because it's a use it or lose it system. You get those tax benefits, but if you don't use it all, then it has negated some of those tax benefits. And then the other big tax piece, we do this automatically. Automatically meaning we do lots of work on the backside, but we do it for you. If we're managing accounts, would be tax loss harvesting. Well, how do you harvest losses? Well, in that case, we look really carefully at positions in a portfolio and make trades to end up where you have a lower net capital gain on your taxes. This is a great way to save tax monies and really take advantage of investment opportunities. With monies we manage, that's part of what we're doing. That's part of the point of having us manage it. With outside managers, that's something to double check that they're doing for you. But there's one important caveat. If we don't know about it, we can't trade in regards to it. So capital gains are in regards to all capital gains you have, not just stock accounts. So if you have a capital gain in businesses or sale of real estate, outside stocks, it's important to let us know so that we can include that in our calculations of capital loss captures to get you a total overarching tax picture. This is only applicable in non-retirement accounts because they don't have that special retirement account wrapper for tax reasons. But so therefore, if you have sold stock for either gain or loss elsewhere, real estate, other things, it's important that whoever's managing your money knows that the gain or loss outside so that they can properly manage your account for those capital gains or losses. There's some really great strategies that we can employ and help with there. We just have to know. The next bit is looking forward. Well, what's going to be happening here and that we should take advantage of now in regards to upcoming changes? Currently, so much of the political landscape is looking at the election and what's upcoming. On the planning side, I'm looking at taxes. Our current federal tax law expires at the end of 2025. So either it's going to expire and we'll go back to pre-Tax Cut and Jobs Act law, or there'll be some other version or new law. As I tell planning clients all the time, taxes change. They change on average every 7 to 10 years. They're going to change in most people's lives another 2 to 5 or 6 times. But this one is so very known. Our current law expires. It will change. So if we go back to the pre-Tax Cut and Jobs Act law, the big changes there is going to be in standard deduction. That's the first one that people are really going to have impact the way they make some decisions. So I was saying in regards to charitable distributions from IRAs, right? Most people are currently taking the standard deduction because for a married couple, it's almost $30,000. But if we go back to having that cut in half for a married couple, it's only about $16,000. Suddenly, charitable contributions from non-retirement assets have a different play as we look to increase what we're deducting. So that's a consideration for 2026. Those charitable distributions from retirement accounts, it's going to be, I'm going to recalculate that for people. You're just going to have to relook at it again. Does it still make sense for you? Yes, the standard deduction is currently expected to be cut in half. There's some changes in the brackets as well. How that affects you depends on your income level. For some folks, they'll go up or down. But the other one that is a very big change is that the cap of $10,000 on the SALT deduction, those are the state and local income tax that we deduct off of our federal, it's currently capped at $10,000. That goes away. This is particularly applicable in higher tax states, and particularly in states with higher property values. So those state and local taxes, for those of us in California, right? That's your state income tax, but it's also your property taxes. Those are both capped at $10,000 currently, and that is set to expire. And that piece alone will really change the itemized versus standard deduction calculation for a lot of people, even if they're not carrying a mortgage. Over the last decade, we've had a number of people where, the math made sense. It was towards the end of a mortgage. You don't have very much of it left, and therefore the interest is relatively low. There became less and less a reason to carry it if you were no longer itemizing on your taxes either. That math is going to change again, and it'll be just another piece to consider. Are we on standard or on itemizing, and the balancing act of our various financial decisions. The last piece of the tax law change that is applicable is estate taxes. Currently, estate tax exemption is very high. And it is set to go back down to about 5 million per person. That's still a sizable number. It's not the million it was, a couple decades ago, but that is inclusive, of real estate and all the other things you have. It's for many couples, it doesn't matter as much for the first party, but if the first spouse leaves everything to their surviving spouse and some strategic steps are not taken, they could easily be over that 5 million number if they're holding some highly appreciated assets and such. So the role of estate planning is, if the estate tax does drop back down to 5 million, may come back into effect and be needed to be utilized a little more strategically. And in that case, it'll be a time to really review people's estate plans, make sure that the plan has some flexibility built into it to allow for a lower estate tax exemption and be able to really protect, so that taxes aren't paid unnecessarily. So those are a few things, both to do now, as well as we look to the future. What changes are upcoming? What steps do we need to take? So those are a few things I wanted to cover. It's back to you, Kristina, unless you've got a few questions for me.
We have one. It says, how often should one review/update their plan?
For a financial plan, those should be updated at least annually, looking to make sure, particularly that nothing has materially changed, either within goals or within the role of various assets on attaining those goals.
Okay, that was the biggest one. And
Excellent.
If I may, because there was another question that kind of tied into that, but kind of went more into the economic side, so I'll save it. But I'm going to kind of answer this question here. So it was a lot of information, but then it kind of handed off, to, again, the questions for the economic side. So what I'd like to maybe just kind of tie this together is financial planning is very complex. If you don't see it as complex, you're either very fortunate fortunate or unfortunate, I guess it's a matter of definition, right? To have nothing really going on, or you don't know what you don't know. All of these pieces that Katie was talking about here, that's just a little piece of the types of things that we're looking at when we're doing financial planning. Very little sliver of that. But as Katie mentioned, a number of these decision points can have significant tax impacts on you, not only today, but in the future. Oftentimes we see, lesser quality financial projections that are done, like by your 401k provider, something like that, that's saying, well, if your investments grow at this much over this period of time, you'll have this much money you can draw from for the rest of your life. It's far too simplistic. And then what it leads is a dependency on market returns for your feeling of success, right? Markets are going up, you feel, oh, great, I got lots of money, everything's doing great, I'm ready to retire. And markets go down, it's like, oh my gosh, I'm going to be eating cat food, right? It's that concern. As we know, markets are volatile, they go up and down, which is why the strategy you employ during the growth phase, accumulation phase, when you're putting money away when you're younger, the pre-retirement phase, and the post-retirement distribution phase is critically important to get right. Because mistakes there can lead to be the difference between having plenty of enough money to last the rest of your life or not running out before the end of your life, or not be able to pass on to your kids, or whatever your highest intention is with that. So the investments are important, and that's kind of my role with creating the buckets and monitoring the economy and things like that. However, we have to depend a lot less on the investment returns, which, as you all know, as I mentioned, unpredictable, in the short term especially, when you can also incorporate the tax planning into this. How do we pay as little in taxes as legally possible means more money in your pocket. A simple fact. We don't get to use the word guaranteed very often in our business based on regulations, but less you pay in taxes, the more money you keep. So we look at all the different tax laws and how we may optimize them. As Katie mentioned, we have a major change potentially happening next year. I'll talk a bit more about that in a moment on the economic side, with the Tax Cuts and Jobs Act and what happens to that at the end of 2025, which is going to be based somewhat on who gets in office as president, but even more so in Congress.
Even
ultimately
more
it's
so.
Congress. They're the ones that are going to finalize these decisions. So those changes could really drastically change. There's areas, Katie and I, for most of our clients at well over 22 million now, many of our clients, we don't worry too much about the estate tax. But that'll change if it drops down, if it expires and it drops down to 5 million. That will impact more people. How do you plan for that? What strategies do you put in place? And this will change multiple times in your lifetime, depending on your age and your longevity. So navigating those rules and making sure you're properly positioned. And I'm going to tell a little story just to kind of tie this together. There are a lot of people in California that have owned their homes for a long period of time with significant appreciation in those homes. And for a long time, what happened with them, or I should say in recent years, people would say, I can't move because if I move, I'm going to pay much higher property taxes and I'll lose most of the money to taxes. About 40 something percent, at least for most people selling an appreciated home, disappears. 40% out the window. Again, it depends on the factors. Prop 19 allowed you, if you're over 55, to transfer your property taxes within California with certain restrictions, but it didn't help with the capital gains tax. So it's a really consideration. So people that don't have access to this information, they just go, I'm going to sell my house and move next to the grandkids. And I'll have all this money to live my retirement and spoil those little suckers. Bam. They did not expect the tax hit and the moving costs. And when everything's said and done, they don't have enough money. And they're also having to pay for new housing. Even in a lower cost state, that can put them in a pinch. So planning can also help prevent unnecessary surprises in decisions that you think are quite simple. I'm selling the house to move next to the grandkids. So it's not all about the portfolios, as Katie mentioned. There are three pillars. The plan itself, changes in your life, your goals, your objectives, your intentions and whatnot, and also what's happening in legislation and politics and policy, regulation, tax changes and whatnot. All of these things matter and they're always constantly moving. Last thing I'll touch upon, Kate talked about a tax loss harvesting. I love the end of the year. Christmas for me comes early. Christmas for me comes early. Dear clients know this. I can't wait. I get into November and I start looking at the portfolios. I'm like, how can I save my client on taxes this year? And we know you, and we know what we're doing. And we go through that. And Katie goes through the planning side and I go through the portfolio side. And we're constantly looking for ways to save. And you don't see that. You don't see that. You just see the performance, right? You see the performance net of fees. You're like, okay, Kristina is doing a good job. I don't necessarily see that, but if I can save you in taxes now and in the future, it's huge. It makes a big difference. And sometimes you'll see these trades in portfolio. She goes, why did she sell that? And then she bought that. Then she sold, or she bought that again. And she did these kind of odd things. It doesn't make sense. It's tax strategy. It's tax strategy because it makes a big, big difference long term. So sorry to show so much excitement about such a maybe boring thing for many people, but that's how Katie and I work. We get excited. We like to look at how can we make this outcome better. And the end of the year, yeah, there's a lot we have to do end of the year. It's a busy season for us. Sorry, meetings can take a little longer sometimes because we're taking care of all our clients, making sure everybody's positioned. But then whatever happens with the election, and then whatever happens is Congress gets into negotiating the Tax Cuts and Jobs Act, depending on the outcome of that, we're going to be talking to you again if it affects you. Okay. The media will say, we're all going to die, or it's the best thing ever, depending on what media you watch and who's in office. However, it's going to be individual. And we're going to look very, very closely at how this and any other changes that come out of Congress will impact you. So I just wanted to kind of wrap up the planning side of it, say there's a whole lot that goes into this. Your only role in this, all we ask is you tell us when you've had a big life event. You tell us when you're even thinking about something, even if you think it's completely crazy and impossible. Talk to us. We might be able to make it possible. These are the reasons important things because we're working off our last conversation. So if something's happened, we don't know about it, we may not have adjusted the plan properly. So please let us know. If you're super busy with whatever this life event is, whether it's a positive event or a more challenging event, shoot us a quick sentence, 2-sentence email and let us know so we know kind of what to focus on with the planning going forward. Also, if you're sitting together and maybe having a glass of wine or looking at the sunset and you're saying, wouldn't it be great if we could do this? Ask us. Let's see if it's possible. So, but thank you very much, Katie, with the year-end planning. I know there's a lot going on at the end of people's year. That's why we wanted to do this in October instead of November or December as everybody gets into the holiday season. The last thing I'll say before kind of closing out the planning side of it, and Katie, you're welcome to hang out or you can go, depends on what you want to hear.
Yeah, I'll stay and listen in case any
maybe more
questions
questions will come
end.
too. Yeah. Before I hop into the economic side of things, One last thing I want to say is our live in-person economic outlook event is going to be a little later this year because we've got Strider again, the amazing speaker that everybody loved and told you all about AI before you knew what it was. Anyway, we've got him, but he's tough to get, so we got him on the 20th of February. So for anyone who is in the Bay Area, we don't have a location picked out yet. We will mark that day on your calendar, and we'll give you more updates as we get closer. So yeah, a little bit later start just because we wanted a really good speaker. In the meantime, we will continue to do these webinars so you will be up to date on everything that's going on. Okay, I don't have any other new questions came, so I am going to hop in here. So Katie is going to just be off camera, but she is going to be present just in case anyone comes up with any more questions, or if questions come across that we both will participate in, we will do that. So without further ado, this is your last economic update pre-election. We have been getting a lot of questions around this subject. I'm sure as everyone listening knows at this point, it is an incredibly close election. There's a lot of emotion on both sides about the desire to win, the need to win, et cetera, et cetera. There's also a whole lot of fear out there. If the wrong side wins, what it's going to do to our economy, country, et cetera. So a couple of caveats for those of you who listened before already know this. It's not really caveats, but it's what they call it, housekeeping. I personally am not registered with either political party, and I'm not here to try to convince you to take one side or the other, one position or the other. I am simply here to provide economic data and information. I'm not also here intending to offend anybody or to make anybody stressed or uncomfortable. And my role is just to give the information as I see it. The information that I'm sharing is from governmental websites. It is not from news media, et cetera, except for the questions that have come up did come from news media sites. And if anyone wants the source of any of the information I shared today, I am happy to share it with you. So you yourself can do your own research and due diligence and be informed. I bring that up because there's just a tremendous amount of information out there that is just simply not factual, especially in the, I focus really on the economic side of things. And it's a little challenging, right? And sometimes it's very easy when you have a specific belief or opinion to glom onto news that supports that or information that supports that. There are three things I'm seeing a lot of. And again, I'm focusing very largely on the economic because that's my job. Obviously, there's a lot of other things out there that people are also looking at as they're making their election choices. A lot of it, what I see is cherry picking. So each morning I check all the main news channels online just to kind of get a flavor of what everybody else is seeing. So I'm prepared for questions. And I see constantly when pieces are taken out of official data, but they're kind of massaged in a way to support one candidate or another or one policy or another. That is a bit challenging because if you read that, you say, oh, this and such. However, it's only a piece to the puzzle. It's not true. The other one is, information out of context. You see that a lot where, again, very specifically cherry pick data to support a cause or narrative. And the final one, sometimes they're outright just nonsense. All right. And I will say I've seen it with both sides, both presidential candidates, both parties. It seems to be kind of spread about here. So my goal today is if there's something in your mind that you have heard on the news, from your social media, from your friends, that is of either a concern or of an interest to you, please send me the question. Please send me the question. The question, that way I can answer it in real time and you're going to get the answer in real time. If I don't know the answer, I will follow up with you. Or I will, if I know who you are anyway, I'll follow up with you and I'll do my very best to answer those today. My intention is you don't lose sleep over what may or may not happen in the next couple of weeks here. So on the election on the really high end, for those of you who heard our previous presentation with Bob Stein, Bob Stein is an excellent Washington analyst / economist. He has extensive experience working in Washington. He's worked under both Democrats and Republicans. He's very experienced, very knowledgeable, very connected in Washington, and he was our guest speaker a couple webinars back. And I had an opportunity to talk to him today, yay, and get his updates. You may have seen him on financial news. He's on Fox Business, CNBC, and some of the other ones. So I was able to get his snippet as of today, and nothing has meaningfully changed since the information he presented at the last webinar. So his outlook for who will likely win the presidency, as well as where Congress is going, has not meaningfully changed based on the information and data he has. and he's got a pretty good track record, so he's worth listening to. But he said the caveat is anything can happen in the next couple of weeks. So that is timestamp this the 15th of October as far as that's concerned. So nothing has significantly changed since his last presentation, even though it feels like things have changing every single day. So the big questions that are coming up the most of that is kind of what is my crystal ball saying? Like I somehow know how the election is going to end up. I don't personally know. Bob Stein has his thoughts on it, and I'm just going to go with him at this point because he's far more knowledgeable and more expertise on Washington than I am. But what I will be comfortable stating at this point, that Congress is very likely to be split. And that is really what I like to focus on today. Because whether we have a Harris presidency or a Trump presidency, from an economic perspective, each have their quote unquote pros and cons. And it also depends on what you want to focus on or what's important to you. So I'm going to talk a little bit at a very high level, and then I'm going to answer the questions. The split Congress, and that's what Katie and I were kind of touching upon earlier, this is really what we want to focus on here. Because when we have a split Congress, and even if Congress is all Democrat or all Republican, it's really close, like it was under Biden's administration, right? It was Democrat, but it was very close. And what happened is you have moderates in there. Don't forget about the moderates. Okay, they can vote either direction depending on the specific proposal or policy that's being presented. So even when Biden had a majority, he did not get some of his more significant, let's just call them, economic policies through because of one vote. One vote. And I personally really didn't like those policies. It would have been devastating for the market and the economy. So I personally, Senator Manchin of Democrat West Virginia, you're my best friend, because he was the one person that stopped that. I hope I don't offend anybody here, because I really, really look at economic policy. And this was purely economic policy. It wasn't any of the social aspects. His reason for not doing it was he was concerned about the cause of that would make inflation worse. And he was absolutely correct on that. He really was looking at the economics, and unlike many people in Washington, he actually does understand finance and economics. So his vote was not a partisan vote; it was a values vote of his concerns. So that being said, why I bring that up is when we have a split Congress, or even again, if it's close but we have moderates in there, major policy doesn't usually happen. Major shifts don't happen. So if Harris wins the presidency and she pushes through her tax increases that she's talking about doing, they're going to maybe change a little bit because they're going to have to be negotiated, and it's going to have to be horse traded. And if Trump wins and he wants to tariff the world, he's not going to get that through because he's going to have to negotiate. So everything with a split Congress, it tends to mute massive changes. I'll talk a little bit about where that can go sideways in a moment. So right now I'll just focus on that. So at this point, there with the Harris presidency, there will be almost certainly, this is the words from her website directly. So I go to both Trump's and Harris's website to get information. Taxes will increase. Taxes on capital gains will increase. Taxes on corporations will increase. There's definitely an idea of taxes increasing. There's not clarity on all the details of how, and of course, again, this will be negotiated through Congress, but expect more regulation and higher taxes per her website, for her ideas. Under Trump, a prediction based on his words at his website, higher tariffs, bringing it back to the US, doing more things in the US, kind of more of that type of policy built in the US, which is an interesting thing because that's actually something where the Democrats and Republicans, where Biden and Trump are on pretty much on the same side. Bringing it in the US, reshoring, onshoring, and doing more here. That does, of course, drive up costs. But the idea, and this has been a focus in the semiconductor industry, is also from a national security projection. So that's the biggest idea, the differences between the two. Trump, lower taxes. He wants to extend the Tax Cuts and Jobs Act, and he wants to go bigger on it, whatever that exactly means, we don't know yet. But that's what he's been talking about. Both Trump and Harris have been really populist in a lot of their economic policy. Populist was they're trying to appeal to the average American person. No taxes on tips, which started off with Donald Trump, and then Harris campaign also took that on as well. No taxes on Social Security is a Trump policy. No taxes on foreigners living, Americans living in other countries. The list goes on. There's a lot of this populist ideas. Now, with all due respect to the Harris and the Trump campaign, if you cut taxes, the government is massively in debt. The spending rates are extreme. at this point, and I'll talk more about that in a moment, you have to figure out how we're going to pay for things, or the deficit is going to get worse. So whether it's Harris with a big government spend policy, or Trump with a big tax cut policy, all of this leads to more on the national debt, which is a massive issue right now. The rate that the government's spending has been quite nice for the stock market, quite decent for parts of the economy. However, we are running towards a cliff, probably later this decade. That is going to cause serious, serious problems. It's a math problem at this point. I don't see either Harris or Trump or the incoming Congress doing anything significant to change spending. I don't see that by any of the words that they've said at this point. So we will enjoy this Goldilocks period, maybe a bit longer, but this will lead to a reckoning down the road. Don't mean to come across as negative. We will plan and prepare and solve for that as we get there. We're not there yet. It is going to be an issue. Right now, see, what do we got? The last 4 years, our deficit, which is how much the government spent in relation to how much it brings in. This is the last 4 years. So yes, it is the current administration. $7.65 trillion. Massive amount of money. Okay, significantly higher than what it was under the previous administration, but it was only just when the spending all hit. Okay, so the spending, this is just a deficit, so it's not just how much the government is spending, it's also how much they're taking in. Remember that. They're bringing X in tax revenue and they're spending Y. The difference between the two. The interesting thing is that in the last 3 years or so, there's another thing. This is, oh, by the way, the information comes from the General Accounting Office of the government. This is nonpartisan. It's data. It's all available. If you just go to goa.gov, you can get this information yourself. The interesting thing is that there's 1 trillion, and let me see what they technically call that, improper payments, which is the official definition of we have no idea where that money went. So think of it this way. Our government spent over $1 trillion in the last 3 years, and they have no idea where that money went. Let that sink in for a bit. So we could help a lot with this spending to debt levels quite a bit with just trying to figure out where that 1 trillion went. That'd be a great start. I'm going to put that on the list of whoever wins. But I want to bring that out there because it's the spending, but it's also the misuse spending and the what we call wasteful spending. That a lot of that, if that can be reined in, understood, or controlled, could help give a lot more flexibility to government spending in other spaces, as well as starting to knock down this debt that we have over time. We're at 35 trillion right now. Again, going to be a big issue. Sorry to be negative, Nelly. And I don't really think there's going to be a big difference between what Trump is going to do and Harris is going to do when it comes to the debt, based on what they're stating, with the caveat, it's an election. They're marketing right now. They're selling to you. They want you to buy them. They want your vote. They're going to promise you the sun and the moon in the sky. When they actually get in office, sometimes they'll pull back a little bit on that, and actually it could be. And Trump has alluded to this a couple of times. Harris may as well. Right now, again, they're on win-win-win mode. So it doesn't mean that they're not actually going to pull back on spending and start to take this more seriously. That doesn't get you elected, though. So right now it's like stuff. I'm going to give you stuff. Okay, let's see. Other big questions here I had was about the Tax Cuts and Jobs Act and kind of what does that mean? And a lot of it came from questions that came, I think, from media, which is the Tax Cuts and Jobs Act was passed under the Donald Trump administration. In order to make it fiscally responsible, it expires and most of it expires at the end of 2025, as Katie mentioned. If it expires, if nobody does anything, and the Harris campaign wins the presidency, or Harris team wins the presidency, it would expire, and we will go back to the way we were pre-Trump, basically taxes. So higher corporate taxes, higher individual taxes across the board. The 24% tax bracket would go away or be shrunken. We'd just go back to where we were before. If Harris wins. If Trump wins, he said he's going to extend it and he's going to give more tax breaks, his words. That being said, don't forget it all has to go through Congress. So it's not going to be either one of those extremes unless Congress is so divided and so bitter and so fighting that they can't find out a solution for it. Then it will just expire because it can't. And this has happened in the past, so it is theoretically possible to do. But higher probability is that it's going to come out in a different form than it is today, and whether that form is lower taxes or higher taxes is going to depend on the makeup of Congress and what they're able to negotiate. But I did want to go about the thing that I got a number of people say is only the wealthy benefited from it. It was a tax cut for the wealthy. So this information is available on the IRS's website. And I'm happy to send you the link if you want. I love the IRS's website. I didn't say I love the IRS. I said I love their website. Their website is so much information on if you know how to use it and where to go. What they do is they compare tax years. So you can actually see where the money's coming from that flows into the government from all of us taxpayers and who is paying it. And not their personal names, of course, but the tax brackets and the income levels and things like that. So what you can go is look at 2017 to 2018 data. And the difference is the Tax Cuts and Jobs Act passed in 2017. So in 2018 was the first tax filing year under that new act. So here's the breakdown. I'll just read this very quickly. People making 15 to 50,000 a year saw the average tax reduction in their taxes by 16 to 26%. Remember, it's not just income taxes, it's all taxes. The taxes they paid on Social Security, the taxes they paid on their distributions from retirement accounts. It's collectively the same tax return 2017 to the same tax return in 2018. So 15,000 to 50,000 income saw 16 to 26% tax reduction. 50,000 to 100,000 saw 15 to 17% tax reduction. 100,000 to 500,000 income saw 11 to 13%. Over that, it was in the low single digits, mid to low single digits. At people over $1 million, about 50% less than the people at the mid tax levels or an average. So usually, depending on their actual filing, gets more complicated. They're all in the single digits. So it was not a tax policy that benefited the wealthy by percentages. By actual dollars, of course, right? So 15% tax savings in dollars, real dollars, is going to be less, but it's still 15%. It's different. So that just shows you an example of how you can take data and just go on either side of the narrative, right? But on a percentage basis, which we use because the dollar amounts are so different, it did benefit the people at the lower income levels that are taxpayers more than the people at higher income levels. But in nominal dollars, certainly, even at 5%, $1 million earner and above is going to see more dollars saved in that. The other thing about the Tax Cuts and Jobs Act, I'm saying the things that impact most people. The two biggest impacts that you can see that affects, and Katie touched upon this earlier, the 24% tax bracket is nice and meaty, covers a lot of people right now in that lower bracket. If that goes away, that's immediate tax impact. Also, as Katie mentioned, the standard deduction being doubled under the Tax Cuts and Jobs Act. If that goes away, that's going to impact a lot of people. Again, I'm not using this as scare tactics. Whoever wins and whatever tax policy is, we're going to have a plan for you. So don't worry about it. I'm only bringing these things up just to give you a bit of that information and kind of things that we're looking at. Most certainly, the last time we saw this really be done in a meaningful way before the Tax Cuts and Jobs Act was under the Obama administration. I'm not kidding you. They passed it on freaking New Year's Eve. No time to plan for anything. But that was how much Congress was fighting and debating and negotiating, and they finally got it done. I'm not kidding you. I think it was literally signed in like 11 something at night on the 31st of December. So it made it a little trickier. And it was all, effective then that following year. So there was just no window to plan. Depending on Congress this time, how early they get to it, and how soon they get it passed, there may or may not be an opportunity to plan in that calendar year. However, as we start to see how the makeup of Congress, the results of the presidential election, we will start to plan for these changes into our individual clients. So I know I spent a little bit more time on that one, but that's the one I get the very most questions on right now. So I'm going to hop over really quick to questions. I'll start with this one. Is it true that taxing the uber rich can have a negative effect on someone like me, a regular person, and the little money I have invested? It depends how. It depends how they're taxed. And I'll throw something out there, and that's going to come into one of these questions here in a moment. We've had a massive investment in with all this money the government's been pumping in the system. The fun, interesting little thing is a lot of corporations, what they're doing with this money when they have access to it, is they're actually investing in technology, and it's making them more productive, even with less work, less people. Not that they're laying people off, because look at our unemployment numbers. They're dealing with the fact that our workforce is rapidly shrinking due to demographics, and they need the work, so they're doing it more through technology. That's why these earnings numbers are good. The earnings numbers are good for two reasons right now why the stock market is so happy. Because of the fact that the companies are learning to do more with less through the use of technology, and they're investing in technology. However, it's a Goldilocks scenario. They're not laying off all their workers. They're not like, oh, cool, we can just let everybody go. Look, we got AI. No, they're keeping their workers. They're just finding a way to grow with less workforce available. And so again, I'm being very general in this. But yes, the higher the taxes are, when they say we're taxing just the wealthy, everything, I know this is not a popular term, it's the best one to have, everything kind of flows down. It doesn't mean it's direct though, because it depends how they're taxed and what, if anything, it will do to you. Taxes make a difference. Taxes on corporations will impact your portfolio even as a small investor because it impacts corporate profitability. Regulations will impact corporate profitability. All of them, I'm not to say whether these are good or bad. There's regulations that are absolutely essential for a functioning society, and there's regulations that are just complete governmental money grabs. Kate, I'll speak for us. I have to do 5 ethics exams every year and pay fees to all these government regulatory organizations. It's the same freaking exam with a different stamp on it from whatever the government organization oversees me in this capacity is. 5 ethics exams every year. I'm almost 56. If I'm not ethical at this point, we got a problem. But that being said, there's just a lot of regulations, a lot of bureaucracy that can probably be filtered out and streamlined and customized. So regulations also can have an impact on you, on the average investor too. So it's not just the taxing the wealthy. But all taxes aren't bad, and all taxes don't trickle down. It really depends on the taxes, how they're used. But if a company gets hit by higher taxes but can work their way out of it through innovation, it's net net. But if the company didn't have those higher taxes and work their way through innovation, that would be more money that would flow through to the shareholders of the stock in those investments. So not an easy question to answer. This is why populist things don't work well. There's never a one size fits all. It depends on the situation. Okay. Oh my gosh, I just realized how little time I have here. Okay, Trump tariffs. What will happen to the economy? It depends on what kind of tariffs and how they're employed and to what capacity or to what scale. And I'll use an example. Trump used tariffs on his last administration when he was in office. He put tariffs in place. And when Biden came in, Biden pretty much got rid of all the Trump stuff. Yeah, he didn't want anything to do with Trump, his immigration policies, et cetera, et cetera. But he didn't get rid of any of Trump's tariffs, which is very telling, right? He didn't get rid of any. He kept those there. Even though he railed against them, he didn't change them. And since Biden has been in office, he's increased he's added tariffs, 100% tariffs on Chinese EVs. So he's added tariffs. Tariffs, if wisely used, are a strategy to keep trade balanced and fair, right? There's a reason that we have tariffs, and other countries do as well. So it's very different when we're going to strategically use tariffs to increase our, competitiveness to help protect U.S. companies. And that is exactly what Biden did with the tax on Chinese EVs, not to destroy the U.S. Auto industry as those cheaper cars were coming in. If it's used wisely, tactically, with thought, it's a good thing. If it's used indiscriminately, if it's used without a thought and analysis behind it, it can be damaging. So with Trump's tariffs, we just don't know what they're going to look like. So to say that they're going to be great or devastating is just speculation at this point. Another question about him, what immigration policy is better, Biden's or Trump's? Well, Biden's doesn't really matter because he's going to be out in a short period of time. We don't really know what the Harris campaign's immigration policy is. We know that Trump is really focused on this subject with illegal immigration, not so much legal or immigration. So immigration is critical for our economic success. However, carefully vetted and crafted immigration so that we don't have so many people that overrun our resources. At the same time, we're constantly bringing new people in, not only to fill jobs, but also to keep our population growth in the United States. One thing to keep in mind is we're barely replacing our population in the United States through what I call domestic births. So we need that in order to fund Social Security and many of these programs going forward. So not to sound like a cold-hearted economist, carefully crafted and well thought out plan for immigration, legal immigration is critical for our country's success. So the extremes on both sides economically don't work. And what we see experienced recently economically doesn't necessarily work. However, a good bipartisan policy in place, crossing my fingers here, would be helpful economically. Explain the Harris housing plan, how the Harris housing plan will work. Um, Probably going to be very fast with this, but her proposal is to give, I believe, $25,000. We don't know to who. It's sort of vague. So it's more of a campaign talking point right now. Like I call it election marketing. We don't know the specifics, but somehow give $25,000 to first time home buyers, but we don't know who those home buyers are and what that look like and where it's getting paid for from. And then also incentivize builders through tax credits and other incentives to build 3 million new homes. So I'll talk more about that if she's elected and if this goes forward when we have like the technicalities of it, because right now it's still at the campaign marketing stage. We don't really have the specifics of how that would work and who may qualify for it, and if it's doable, if it goes through. I'm skipping past some because I feel like I covered them earlier. Which candidate is best to lower costs? We don't know. Sorry, I can't answer that. Larger government spending, more money pumped into the system is inflationary. We've seen that very, very clearly a couple of years ago. And while inflation is growing more slowly now, it is still growing. Okay, we're down in the mid twos, which is a good thing, but it's still growing. I mean, so remember, we went up shop 9% and it's still growing off that 9%. So when people say inflation's going away, inflation's coming down, and all those things, that's nonsensical. We're just growing more slowly. We're still going up. Inflation is a lot of it is this massive amount of money I talked about earlier being pumped in the system. It continues to be pumped in the system. That's creating the inflationary, but there are other things that create inflation as well. I'm going to talk more about the economy next year in an upcoming webinar. You might be surprised by it, but inflation's coming back. Doesn't matter if it's Harris or Trump. We're going to be navigating this again probably about this time next year. And more government spending is generally inflationary because it's pumping more money in the system. The basic definition of inflation is too much money chasing too few goods. So it's just the reality of it. It doesn't mean that that is going to create this inflation. There are other causes to it as well. So it's not really hard to say who is going to create more inflation or who's going to make inflation lower. Lower regulations will help because there'll be lower cost to businesses, which could also reduce costs. So you see there's a lot of inputs to inflation besides the headline number. I always call it, there's the inflation number, the official, and then your personal inflation. All right, sometimes inflation's coming down. Well, now if you look at your homeowner's insurance or your utility bills or pretty much anything else you're spending money on right now, it's all going up, even though inflation is moderating. So it's your personal inflation number. It can be different than the government's official number. Okay, I think this one's an important one to touch upon here, and that is, would it be wise to reduce risk in a portfolio before the election? There's a lot of variations of that question that we were asked, and it really depends. It really, really depends. And the most important thing I think about is twofold. Number one, if you're young, as Katie mentioned earlier, if you're young and you're in the growth mode, right? You're going to see this up and down swings, up and down swings. How many people remember just a few short years ago that your portfolio was, if you were high growth, aggressive investor, your portfolio went down almost half in the first month of the pandemic? Doesn't feel like it anymore, does it? Why? Because the markets have gone way up from where they were even before the pandemic, right? So you don't feel it. How about the housing crisis? Your portfolio, if you were 100% in stocks, dropped 50%. Right? If you were just in the S&P and not having it professionally done, you drop 50%. That was the S&P's numbers. But you don't think about that now. So the market always is going to have risk. There's always going to be drawdowns. Historically, 2/3 of the time market's up and 1/3 is down. The down is your price of admission to get higher growth over time. Good managers that know you and your situation and understand the market and economy can help also increase, potentially, I'm not allowed to promise that anyway, it can potentially help increase your success. Final thing on that one is if you are concerned about the markets, that's a conversation I have with Katie or myself, and we can decide if that makes sense within your plan. A lot of times when you watch a lot of news, it can create a lot of unnecessary fear that the world is going to end. I will tell you that generally the things that end the world are things you don't see, the short term, like the COVID. So the answer to that is it depends on your individual situation. However, it would not be related to the election. It would be in general, you should have this much money in a more conservative place because you need it, and we can't take a chance that anything could happen out there. Don't forget, there's a whole wide world out there full of exciting little issues going on right now. So it doesn't just have to be the election. Each individual will make that decision. Best to consult with Katie and I on what is best for your individual needs. I'm going to save the housing questions. There's 3 of them. I'm going to save it for next webinar, only because they're not really critical to anything going on with the election, and actually would actually be more clear after the election. Okay, the last thing I think I'll hit here is what I touched upon is, and it's going to come on to something that Katie said. So the markets right now, again, doing very well twofold. Number one, there is an increased probability that the markets are going to experience a favorable outcome with the results of the election. And they're excited about that. They're excited about the government spending. But I'll tell you what we're starting to see in earnings right now. So you're going to get a sneak peek on next month's talk. What we're starting to see is that companies are innovating their way out of the higher costs, input costs, the higher labor costs, the higher materials costs, the uncertainty around regulation and the election. They're navigating their way out of that through innovation. We're just starting to see little bits of, we got a lot of financial releases already here, sector releases. And I'll see if this continues. We're just in the early stages of earnings right now, but we might actually be able to navigate, the markets may be able to navigate themselves through a pretty extraordinary time of uncertainty, even though they're holding back on innovation and spending in some areas because they want to see how the election goes. But other things are like, doesn't really matter who's in office. This is going to make us more productive. We're going to put money here. So this is giving an opportunity for companies to work their way through the uncertainties through innovation and whatnot. And that really helps. Whereas early on in this year, or even in normal election cycles, you see bigger pullbacks, companies not spending. They're like, well, I'm not spending until we know who's going to win because we want to know how we need to position. You're actually seeing a lot of them saying, hey, innovation, tech, AI, that's going to be benefit us regardless of who's in the White House, and we're going to put money there, and you're starting to see the benefits on that. So that would like to do. There could be volatility around the election, especially if the election's very close. It may or may not be decided in the first day after the election. It may be a little bit like a 2000 scenario with, remember, the hanging chads in Florida, and things are going to get recounted. So I'm not going to say it's going to be smooth. It's going to be easy. However, regardless of the results of the election, Katie and I have a plan in place of how we will position client portfolios and also your financial plans. I will save the remaining questions because I want to respect everyone's time as we're coming up on the hour here. However, you don't have to wait for the next webinar. If you have more questions, do not hesitate to reach out and we will be happy to answer them. Katie or I will be available for that. If you're not sure who to ask one of us, and one of us will get back to you. We'll just make sure it gets to the right person. Most important thing is don't worry. Don't worry about the economic results of this. There's a lot of issues I understand that are important to people outside of the economic policies. And in no way, again, is this meant to push you to one direction or the other. We really, really want to cover this because to kind of assuage some of the fear that's been out there, the concerns and whatnot, and also to really strengthen and remind everyone that regardless of the outcome, we're going to be there. And after the election, there'll be a whole host of new things for us to keep an eye on. Any questions you have anytime, please don't hesitate to reach out to Katie and I. Your success is most important to us, and whatever we need to do to get you there, we're here to help. Thank you very much for listening to everyone, and reach out with questions and see you next month, if not earlier. Bye for now.